Hey folks, Manley Haines here. Think you need 20 grand in the bank to buy your first home in Wisconsin? You might not. And that misunderstanding may keep you renting forever. In this mega episode, we're breaking down the 2026 Wisconsin First-Time Homebuyer Blueprint. Zero down, USDA options, WHEDA updates, and real numbers behind the cash to close. No internet guesses, no aunt and uncle horror stories, just real Wisconsin strategies. We'll also cover 2 approval killers: buying unmarried without a plan and filing taxes before you know the mortgage impact. Let's cut through the noise and get you into the playbook. Most folks know their down payment amount. That's the easy part. But what almost no one accounts for is their above and beyond the down payment number. That's a big one. That's the title fees, insurance prepaids, and tax prorations that sneak right up before you grab those keys. And let's be honest, most loan officers skip this early on, especially if they think you're still shopping. But that's not how we roll. We lead with full transparency, from pre-approval to the closing table. We do the math with you, not after you've already written the offer. Today, I'm popping the hood, sharing my screen, walking you through a real-life dang that's a good funds and beyond calculator. I'll show you exactly where many buyers can get blindsided and how ours stay in the know all the way through their mortgage journey, and how you can too. Welcome to Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm your host, Manley Haines, and today we're rolling up our sleeves and getting into the real numbers. Now, if you've ever wondered, how much money do I actually need to close? This is the episode you've been waiting for. I'm going to share my screen and walk you through some real funds to close scenarios using a tool I built to show you the actual all-in needed to close cash. We're talking line by line, title fees, insurance, tax prorations, the stuff most people don't see until it's almost too late. It's not a guessing game, and it shouldn't be a surprise. So if you're out there house shopping or even just getting prepped, this is the breakdown that will show you exactly how we keep our buyers from hitting that last-minute cash crunch. All right, let's fire up the calculator and plug in some real numbers. Hey, just wanted to bring you into the office and see how I walk a customer through understanding their funds above and beyond the down payment calculation that they need to know so they can feel comfortable and educated about what their purchase price is, how much money they need to bring to the table. So it spells it all out clearly. I'm going to share my screen so you get to see it. All right, guys. This is the dang that's a good mortgage funds and beyond the down payment needed to close calculation. All right, this is for Frank, the first-time homebuyer. The date is today, January 30th, 2026. My section 1 here of the customary things are the cost to actually produce the loan. And I break this down line by line, what's involved, what you're going to see. That total cost out of pocket is about $33.20. I'm right in the middle of where everybody else is on this, so that's good. The second category is the prepaid items. The prepaid items are things that we need to pay, like the homeowner's insurance, and then we have to pay the interest-only payment on the loan to get us to the end of the month for the mortgage clock to start at the beginning of the new month. So this date that I have for this example is February 21st, 2026 is the day we're going to close. And so we need 8 days of prepaid interest. And then at that point, the mortgage clock will start March 1st, and the first payment on this example would be due April 1st. Hope that makes sense to you. So these two things total up to $1,832. Then we got to set up the escrow accounts, you guys. We are escrowing for taxes and insurance on this. Property taxes, I have a placeholder at $47.01 a year, or $391 and some change on the monthly. The homeowner's insurance, again, is $1,200 a year or $100 a month. We're taking 3 months of both of these and setting them aside so that we can have those funds available for future payments. The way escrows work is we're setting that money aside on the monthly so that we can pay the bill when it is due. Property taxes are going to be due at the end of 26. The homeowner's insurance is going to be due 11 months from the day that we close, which is February 21st, 2026. So we would need to pay that bill on January 21st, 2027. So we'll have all those funds available. So that's $1,475. We're going to talk about the outline of the transaction here. We're doing a $500,000 purchase, 5% down. So that's a $475,000 loan amount. And we need $6,627 to close. So here we are breaking it all down, adding it all up. This is what we need total to the table to close the loan, $31,627. It's a great tool, again, that we get to walk through everybody, and they're going to walk away with a piece of paper, which I'll show you just momentarily. But again, breakdown, $500,000 purchase, $25,000 down payment, and a $475,000 loan amount. In today's market, just today, if I was quoting this, I'd be at 5.99% on this specific example with no points. And here's the principal and interest payment on that. Here's the homeowner's insurance monthly contribution to the escrow account. Here's the property tax monthly payment or contribution to the escrow account. And here's the mortgage insurance payment that we need since we're putting less than 20% down. So that's a total of $3,417. Then I'm going to click on this generate a PDF button, and it's going to pop up for me here as we go. And I'm going to email this over to my borrower, Frank, first-time homebuyer, and he's going to see this in writing from me and get an idea of how all this works. If he has questions, he can jump back and we can go through it line by line further. But it breaks it all down. I think it's a great tool, and it helps educate people to understand exactly what they're getting into, and most importantly, the exact amount of money that they need to close the whole purchase at the closing table. The funds above and beyond the down payment and the down payment itself combined. And again, in this circumstance, that's $31,627. Every January, I watch buyers torpedo their homeownership dreams just by trying to get their refund quicker. They write off everything. Their income looks low on paper, and boom, just like that, they're disqualified from getting a conventional mortgage. If you take 3 minutes before you click submit, I'll show you exactly what numbers you need to know before you press send on that return to file with the IRS. Hi, I'm Manley Haines, and this is Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. Today, I'm saving you from the tax season trap. Here's the trap. Your CPA's job is to lower your taxable income. My job? Prove you make enough income to qualify for a mortgage. If you're self-employed or a gig worker, that matters big time. Let's say you made $100,000 last year, but you wrote off $80,000 in expenses. On paper, you only made $20,000. And guess what? You can't be poor for the IRS and rich for the mortgage bank at the same time. If you tell the government you're broke, the bank has to believe you're also broke based on your tax returns. And if you're a W-2 employee, you're not off the hook either. Let's say you file and oops, you owe $4,000 to the IRS. Some folks don't have the cash. So what do? They set up a payment plan. But here's the catch. That $300 monthly IRS payment, it shows up on your credit report. And now, one line item can slash your buying power by $40,000 to $50,000. And just like that, you're priced out of the neighborhood you wanted. All right, so what's the move? Simple. Create a draft version of your return. Ask your CPA or use TurboTax. Just don't hit submit. Save it as a PDF. Then send it to me. I'll run your mortgage numbers as if they were filed. Then I might say, right now your income only qualifies you for $250,000. But if you back off just $5,000 in write-offs, you could qualify for $400,000. Then you decide, do you want the refund or do you want the house? The power's in your hands, but only if we do this before your taxes are filed and it's not locked in. All right, once that return is filed, it's official. You can't undo it without a full IRS amendment, which may take months. Now, real quick, I'm a licensed mortgage pro, not a CPA. I'm not telling you how to file your tax return. I'm telling you how the bank will read and interpret your taxes. That could be the difference between getting the keys and getting denied. If you're thinking about buying a house with your boyfriend or girlfriend this year, hit pause just for a second. I get it. It's Valentine's week. Hearts are floating. The playlists are all Ed Sheeran. But here's the truth. More unmarried couples are buying homes together than ever before, and nearly all of them are walking straight into the same legal trap at closing. Today, I'm going to explain the critical difference between joint tenants and tenants in common, and why one of them could leave you co-owning your home with your boyfriend's mother. Probably not good. Welcome to Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm Manley Haines, and today I'm here to help you protect your equity, not just your heart. When you buy a home, the title company is going to ask, how do you want to hold title? Most folks just look at each other and shrug and check a box. Don't do that. Option 1. It's joint tenancy. This is what most married couples choose. Think of it as last man standing. You both legally own 100% of the home. If one of you passes, the other inherits the full ownership automatically. It's clean, it's protective, and avoids the courtroom. Option 2. It's tenants in common. That means you each own 50%. Sounds fair, right? Here's the nightmare scenario. You buy a house as tenants in common. He passes unexpectedly. Now what? His 50% doesn't go to you. It goes to his legal heirs. And if he didn't have a will, that means his parents, his siblings, maybe even the aunt in Indiana. Or worse, Chicago. Boo! Now you're co-owning your house with the grieving mother. And yes, she can force a sale to access her share. I've seen it happen. It's devastating. Now let's talk breakups. If you're married and divorced, you've got a court system that helps divide the home fairly. But if you're not married, you don't get divorce court. You get a lawsuit, a partition action, or what's called Watts case here in Wisconsin. That's expensive, it's messy, and it usually ends with one thing: your equity getting eaten alive by legal fees. So what do? Before you write an offer, get a cohabitation agreement. It's like a house prenup, and it answers three things: who pays the mortgage? If we break up, who moves out? How long does the other person have to refinance or sell? Don't rely on a handshake. Handshakes don't hold up in court. Now here, I'm not an attorney. I'm your lender. I can't give legal advice, but I can tell you this: I've seen how ugly this can get when couples skip the paperwork. If you're buying with a partner this year, let's run the numbers together, and I'll connect you with a rock-solid real estate attorney that will get you protected. In this video, I'm breaking down the USDA loan in Wisconsin, which areas near Milwaukee and Waukesha qualify, who's eligible, and what zero down payment actually looks like in real numbers. I'm Manley Haines, loan officer with Rate, 24 years in the mortgage business, and USDA is still one of the most underused programs I have because nobody tells the buyer it exists. Most people hear USDA loan and they picture farmland, they picture rural, they assume they don't qualify because they're buying in Waukesha County or a suburb right outside of Milwaukee. Here's what might surprise you. Some of the most popular commuter suburbs in Wisconsin are on the eligible map, and I'm going to show you exactly which ones. We're covering three things: what the USDA loan actually is and how it works, and the eligibility map that applies specifically to Wisconsin buyers in 2026. And then we're going to run the real math, USDA versus FHA versus conventional, so you can see exactly which one saves you more money. And I'm not here to tell you USDA is perfect for everyone, because it's not, but I am going to give you the numbers so you can make that call yourself. The USDA loan is a government-backed mortgage program specifically designed for buyers in a rural suburban area. Here's the thing that most people don't realize: rural doesn't mean what you think it means. The USDA draws eligibility based on population density, not the distance from the city. And that means large portions of Wisconsin, including suburbs that are perfectly commutable to Milwaukee, qualify. The big headline: zero down payment. That's not 3.5% like FHA. It's not 3% like some conventional programs. It's zero. Instead of mortgage insurance, USDA charges a guarantee fee. 1% upfront can be rolled directly into the loan, so you're not writing a check for it at closing. And 0.35% added annually to your monthly payment. Hold on to that number. It becomes really important when we run the comparison. The income limits for 2026 in Wisconsin are $119,850 if there are 1 to 4 people in the home. If you have 5 to 8 people, the limit changes to $158,250. Most first-time buyers in Wisconsin fall comfortably under that threshold. But here's the income trap I see buyers walking into before they even look at the map. USDA counts all income in the household, not just the borrowers on the loan. If a parent lives with you, their income counts. If a non-borrowing spouse works there, and their income counts too. I've had buyers who looked eligible on paper and get disqualified because they forgot to include the family member's income that pushed them over the limit. Know your full household number before you assume you're in. Now the map. Most Wisconsin buyers picture USDA properties as out-of-the-way places they'd never actually want to live. Here's the reality. Areas like Oconomowoc, West Bend, Hartford, Watertown, Burlington, Port Washington, Grafton, and Whitewater. These are real commutable Wisconsin suburbs. Many of them sit 25 to 40 minutes from Milwaukee. Good schools, growing neighborhoods, a solid housing market, and a large portion of properties in these communities are USDA eligible right now. Knowing those areas qualify, let's talk real math. Because USDA sounds great on paper, but what does it actually cost you compared to FHA? Let's use a $280,000 home. That's a realistic entry-level purchase price in the USDA eligible Wisconsin suburb. FHA loan, 3.5% down. That's $9,800 out of your pocket at closing. FHA also charges an upfront mortgage insurance premium of 1.75%, which is another $4,900, either at closing or rolled into the loan. Then the monthly MIP at 0.55% of the loan, the balance is about $128 a month. And here's where the math really matters the most. The FHA mortgage insurance never goes away. If you put less than 10% down, it's on your statement for the entire life of the loan. You have to retire it to make it go away. Now, USDA loan, $0 down. The 1% upfront guarantee fee is $2,800, and that rolls directly into the loan. Monthly guarantee fee about 0.35%, or about $81 a month. Let's just say it out loud. On the same $280,000 home, USDA saves you $9,800 at the start and then saves you roughly $47 a month compared to the FHA's monthly insurance cost. Over 5 years, that's nearly $12,800 back in your pocket between the upfront savings and the monthly difference. Most buyers are never even shown this comparison. They sit across the table from a lender, they hear you need 3.5% down for FHA, and then they go home and they start saving. Meanwhile, there's a zero down loan sitting right there waiting for them. That $9,800, that's your emergency fund. When that furnace goes out in January, that's your moving costs. That's the breathing room that make the first year of homeownership actually feel good. Here's what nobody talks about. FHA gets all the press as the low down payment program. Every first-time homebuyer in Wisconsin knows the name. Every real estate agent mentions it. But for eligible buyers, the right income, the right zip code, USDA quietly beats FHA on almost every metric. Lower monthly payment, zero down, and no mortgage insurance that follows you for the life of the loan. The only question is whether a specific address or your household income puts you at a zero down zone. That's it. The whole equation. Is USDA right for everyone? No. If you're buying inside Milwaukee city limits or in core Waukesha County neighborhoods, you likely won't be eligible in an area. If your household income clears $120,000, you're out also. And sometimes FHA genuinely makes more sense. It has more flexible credit score guidelines. And for buyers who need a lower credit score to get approved, FHA can open doors USDA won't. One size never fits all in this business. But if your target area is on the map and your income is under the limit, running this comparison first is worth every minute. Stop saving for 20% down. If that's your only goal, you're likely waiting for years longer than you actually need to. But on the flip side, stop thinking the down payment is the only check you have to write. The biggest heartbreak I see in this business is when a buyer finally saves up the down payment, finds the dream home, gets to the closing table, and then realizes they're still $10,000 short because nobody told them about the hidden fees. In this video, I'm going to break down the 3 stacks of cash that you actually need to buy a home in 2026. I'm going to go line by line through the closing costs nobody tells you about. And then I'm going to show you specific negotiation strategy to get a seller to pay 2 of those stacks for you. Welcome to Manley's Mortgage Minute, powered by the Mortgage 101 podcast. I'm Manley, and today we're building your cash to close blueprint. Let's start with stack number 1, the down payment. This is the one everyone knows about, but so many, especially first-time homebuyers, get the math wrong. The myth is that you need 20% down to buy a house. This is false. That rule's from 1980. In 2026, the reality is much more accessible. If you're a first-time homebuyer on a conventional loan, the minimum down payment is just 3%. If you have a credit score under 680, you might need an FHA loan, and that minimum is 3.5%. And if you're a veteran or looking in a rural area, a USDA loan, that is literally 0% down. And that doesn't even speak to potential grant programs that may be available to you and are completely driven by where you're looking to purchase. Let's use real numbers. Say you're buying a home at $400,000. The internet says you need $80,000 or 20%. The reality is you might only need $12,000 or 3%. That's a $68,000 difference. That's the difference between buying now and buying in 2030. That $12,000 is only the first stack. Now let's talk about the fees. Stack number 2, closing costs. These are the one-time fees to get the loan done. Now, if you don't want to just budget blindly, I want you to know exactly what you're paying for. A good rule of thumb is 2 to 3% of the purchase price. But let's break open the black box. What is actually in here? First, the lender fees. This is usually the underwriting fee or a processing fee. This pays for the humans who verify your income and structure the loan. Second, the third-party fees. These are the big ones. The appraisal. We hire a neutral third party to prove to the bank that the house is actually worth $400,000. That usually costs about $500 to $700. Then, the title company. This is crucial. You pay for the title insurance to make sure the seller actually owns the house and there are no hidden liens from a contractor 10 years ago. Then the government. Yeah, they always get their piece. Depending on your state, you have recording fees and transfer tax. This is just the cost of telling the county you're the new owner. When you add these all up on a $400,000 home, stack number 2 could range between $3,000 and $9,000. That's a big range. Now stack number 3. This is the one that surprises people the most. It's called the Prepaids and Escrow Holdbacks. You aren't just buying a house, you're prepaying your future bills and setting up an escrow account.
The lender doesn't trust you to pay your property taxes and insurance on your own every year, so we force you to save for them monthly. But to start that account, we need to put a little cushion in the upfront. Homeowners insurance, you have to pay that full first year's premium upfront. That could be $1,500. Then the property taxes. Depending on what month you close in, we might need to collect 3 to 6 or even 9 months of property taxes upfront to ensure the account has enough money in it when the tax bill arrives. So even if these aren't your fees, because it's your money going towards your bills, it's still cash that you have to write a check for today. On your $400,000 house, this could easily be another $4,000 to $5,000. I'm going to add a bonus stack here that Zillow definitely won't tell you about. Stack number 4, reserves. Reserves means how much money do you have left in the bank after you write that check. Now, we cannot let you spend your very last dollar at the closing table. What if your water heater breaks down the day you move in? You're going to need cash. For most loans, we want to see that you have 2 months worth of mortgage payments left over in your checking or your 401k. So if your mortgage payment is $3,000, you're going to need to show us that you have another $6,000 tucked away. You don't have to spend it, but you have to show it to us. All right, the strategy. How to pay zero in closing costs. So if you're looking at these stacks and panicking because the number is too high, here's the strategy. You cannot borrow the down payment. Stack number 1, that has to come from you or a gift. You do not have to pay for stack 2 or stack 3. We can use something called a seller concession. When we write the offer on that $400,000 house, we can ask the seller to give us a credit of $10,000 at closing. Effectively, we raise the price slightly, maybe even to $410,000, and ask for that credit back to you. You finance the costs into your loan over 30 years, and you keep that $10,000 cash in your pocket today. This is the single best way to buy a home if you're cash strapped and have good income. So let's recap. Stack number 1, the down payment, the skin in the game. Stack number 2, the closing costs, all those fees. Stack number 3, the prepaids and your escrow account that you set up. Stack number 4, reserves, your safety net. So now here's the reality check. One size never fits all in this business. While I just showed you your likely case, your specific credit score, your loan program, and even the county you buy in can change these numbers dramatically. Even if you think you have it all figured out, it's always better to talk to a mortgage professional than guessing with your life savings. If you looked at buying a home last year and were told you make too much money for the down payment assistance program, I might need to take another look for you. Wisconsin just updated the 2026 income limits for WHEDA, and buyers who didn't qualify for 2025 may now be eligible. Today, I'm breaking down what changed and who qualifies and how this could dramatically reduce what you bring to closing. Welcome to Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm Manley, and today we're talking about strategy. Here's the biggest misconception about WHEDA. People think it's for low-income buyers. It's not. It's for moderate income buyers as well. And here's what's happened. Inflation pushed wages up, raises kicked in, and a lot of buyers accidentally stepped just over the line. Think of the income limits like a moving fence line. Every year, the state adjusts the fence to reflect the cost of living. For 2026, that fence just moved. For 2026, income limits increased across the board. In Waukesha and Milwaukee counties, 1 and 2 person households can now earn more than before and still qualify. Larger households, even higher thresholds. This opens doors for teachers, nurses, and young professionals, people who thought they earned too much to qualify. So what does that actually mean in dollars? The WHEDA Easy Close Advantage offers up to 6% of the purchase price for a second mortgage that can be used towards down payment and closing costs. On a $300,000 home purchase, that's up to $18,000 that can cover a 3% down payment and a large portion of closing costs. In some cases, buyers are bringing very little out of pocket, depending on how it's structured. But there's one major rule. It must be your primary residence. I repeat, it must be your primary residence. This isn't for rental properties, but here's the part many people miss. You don't always have to be a first-time homebuyer. If you haven't owned a home in the last 3 years, or if you qualify under the Standard Advantage program, you still may be eligible. So, if you were told no in 2025, that doesn't automatically mean no in 2026. Income limits changed, guidelines evolved, strategy matters.